Welcome back to another Overseas DeFi live stream. We do this every Thursday live at 6 p.m. Eastern, and Bitcoin has just completed another 25 to 30% crash just as of last Friday. And everybody is wondering, is this the bottom? Is this the time to buy back into crypto? Tonight, I'm going to give you my investment thesis and the different data points and reasons for me to buy this dip. I do believe that the bottom is in, or at least it is very, very close. But more importantly, tonight, I'm going to be giving you a strategy that you can use to buy the dip, but then you can make use of those coins that you just purchased, and you can actually generate a daily cash flow while you wait for the bottom to be in. Maybe it keeps going down a little bit lower. At least you can generate some income and some cash flow and get paid to wait for the long-term narrative to play out. So a couple of things we're going to go over tonight in terms of some data points that have just occurred recently in the last week that signal to us that the bottom is in. And then we'll get into that strategy again to be able to buy the dip and then take those coins and generate some cash flow while you're waiting for the price to go up and waiting for that price appreciation. At least you can make some money while you wait. So first of all, what is the thesis? Why do we invest in Bitcoin? And more importantly, and larger allocation in my portfolio is Ethereum. So I'm a big believer in Ethereum, and I take this as an opportunity to buy very cheap ETH. So what is the thesis? In a nutshell, we believe that the future of the financial system will be on chain. And with Ethereum and other quality layer one blockchains, you actually have an opportunity to own the rails. So you have an opportunity to own the infrastructure upon which the entire future economic system and financial system will live. And even bigger than that, we are headed towards an agentic economy. It's predicted that AI agents will actually outnumber humans 80-1 in the relatively not too distant future. And that means billions of new economic actors. And those AI agents, they need crypto. They need crypto rails for payments, for settlements, even for identity, and all sorts of data. When you work with AI, everything is based on tokens, right? You consume tokens with your AI model, and that's how you're able to use AI to process information and then output tokens as well. It's not a coincidence that AI deals with tokens. Blockchain also deals with tokens. So a token is just a piece of information, and what we're used to in blockchain is the tokens represent value. A tokenized Bitcoin, for instance. But as the regular finance economy melds together with the AI economy, you're also going to have tokens that represent data, information, output of different AI agents and models. And that's going to be moving around the economy as well. We're headed for this machine economy. And I definitely want to own the rails that all of that machine economy will be running on in the future. So with this thesis, we definitely have interest in Bitcoin. We also believe in the narrative, and it's almost like death and taxes. One of the things that you can rely on in this life is that the government and the central banks will continue to debase the fiat currencies of the world. Every year, those dollars and euros and yen and pounds have less and less purchasing power because the whole system is rigged. Those units of fiat currency are constantly being printed or produced or springing into existence on a computer system somewhere at a central bank. The purchasing power of fiat currency will always continue to be debased. It's something on the order of 8% a year. So we want to protect our wealth. We want an instrument. We want something that's scarce, an asset like gold or real estate or fine wine or rare art or Bitcoin or ETH, where the supply of that asset is scarce. It's hard to produce. It doesn't inflate the way that fiat currency does. And so we definitely want to have part of our portfolio allocated into Bitcoin as a store of value. The thing is, when you look at global store of value, when you look at global savings, people save money in fiat currency, they save money in gold and silver, they save money in real estate, like I said, watches, fine wines, rare art, etc. When you look at global savings across the world, it's about $100 trillion of global savings, and Bitcoin is competing for a sliver of that. Right now, the market cap of Bitcoin is around about 1.25 trillion. So it's very small at this point. And part of our thesis is that Bitcoin will gradually capture a larger share of that global savings market. And it's huge. $100 trillion is no joke. It's probably going to grow in the future as well because of debasement. But it is a capped market. So in other words, there's something in investing called total addressable market. The total addressable market for global savings is capped. It's right about $100 trillion. When you talk about an agentic economy, a machine economy, the sky is the limit. There's no limit to the growth of that economy. We're talking about hundreds of billions of AI agents running around on the internet using crypto rails to conduct all sorts of activities and execute lots and lots of financial transactions, micropayments, settlements, trades, you name it. The AI agents are going to massively outnumber humans. And there's no limit to that. The only limit is how much intelligence that we can produce on a blockchain and in AI and these models and data centers and all the rest. It scales infinitely. So the total addressable market for that side of the thesis is literally unlimited. That's why in my portfolio, I'm heavily skewed towards Ethereum. So those are the assets that we want to hold on to. That's a little bit of the reasoning behind those theses, where we want to invest in Bitcoin, we want to invest in ETH. I also have a big position in SWI. It's another layer one blockchain. It's much more advanced, much higher technology than the Ethereum blockchain. And it's way faster, way cheaper, really purpose-built for the AI economy. So I'm very bullish on SWI as well. But the question is, what do you do after you buy these coins? Most people, the vast majority of people that invest in crypto, they leave their coins on a centralized exchange. Not only is it dangerous because not your keys, not your crypto. If that exchange has some kind of a problem, it gets hacked, it gets ripped off, your coins are gone. Your coins are gone. They were never your coins to begin with if you leave them on the exchange. So the first thing you have to do when you're investing in crypto is actually take possession of those coins. Most people don't even take that first step. But what we do in Overseas DeFi and in DeFi in general is we take possession of our coins and then we turn those coins into productive assets. We don't just let them sit there. We put them to work. They're already working for us in the sense that the price is probably going to appreciate, but we might have to wait a while for the bottom to finally be in. I think the bottom is in. We'll get into that. But we'll have to wait at least for it to base out and finally start to rally and start to trend upward. And we'll have to wait for that price appreciation to occur. So while we're waiting, we might as well make some cash flow on the side. The same thing, a good analogy for this would be if you purchased a piece of real estate. You bought a single family home and your idea is that you're going to buy this house and you think that's going to appreciate. They're not printing more land. So I'm going to buy this house and I'm going to hang on to it. It's going to be worth more in the future, or it's going to hold my purchasing power. It's going to store my wealth for the future. But if you bought a property like that, you wouldn't just sit on it. If you're not living in it, you're going to rent that out. You're going to generate some cash flow. You'd be silly not to generate cash flow with that asset. It's a house. It's meant for people to live in. You would rent it out. Bitcoin, ETH, it's the exact same way, but most people, the vast majority of people, don't even understand that. So that's going to be the main point tonight. I want to show you how to turn those assets, or talk to you about how that works in order to put those assets to work, not only capturing the price appreciation, but also in a way that you can generate daily cash flow. So that will be coming up in a little bit. But first, I want to get into some of the data points that we've seen this week that signal to us that the bottom is likely to be in. I'm actually going to share a little bit of a part of a slide deck that I presented to our accelerator community earlier today. We had our strategy session. So I'm going to give you a little peek of this, and I'm going to give you three main reasons why I think that the bottom is in. It's either in or it's very, very close. I do think there's a decent chance that we might drop down to maybe $58,000 down to $55,000 on Bitcoin. I really, really don't think it's going much lower. But I'm also going to talk to you about how you can reduce your risk, and you can actually generate the cash flow and wait it out and still be safe. It just involves being conservative on your lending and borrowing. We'll get into that. And that way you'll be able to survive if it does actually, if I'm wrong, if the bottom isn't in and we drop lower, even if we drop lower than 55,000, you can set up your strategy and your lending and borrowing to be able to survive that. You can also get into hedging and shorting. I'm not really going to get into that. I do have other videos on the channel that talks about that. But let me share this slide deck. Again, this is from a presentation that I delivered earlier today for our accelerator group. And let me pop it up over here. Perfect. So 3 reasons why I believe that the bottom is either in or very, very close. So hopefully you guys can see that okay. Please don't hesitate to interrupt me if you have any questions as I go through this. I'm more than happy to take a beat and answer any questions that you might have. So we have what we call the on-chain capitulation cluster. We had a big, nasty drop into Friday. That was the low. Just last week on Friday, Bitcoin dropped all the way down to about 59,000 and change, $59,079, something like that. And when it did that, when it dropped on Friday, it went ahead and tagged the 200-week moving average. We can look at that later on the chart. That was kind of data point 1. We tagged the 200-week moving average, which is a well-established technical indicator. A lot of people, a lot of investors and traders are looking at that. And we tagged that moving average, and then bounced a little bit into Sunday. And this is important. The weekly candle on Sunday closed above that critical 200-week moving average. So that's number 1. The other factor that goes along with that is this right here. Now, check on chain, James Check. You can check him out on X @_checkmatey_. He does a lot of fantastic on-chain analysis. So he looks at the Bitcoin blockchain in depth. One of the things he does is he's able to look at the cost basis of every single individual coin on the network. And so you can look at that collectively, and you can determine what is the average cost basis of every single coin in circulation. And you group that all together, and you come up with one number. And based on where the price is right now, and everybody's cost basis for all on-chain coins, right now, when we dipped down on Friday, we reached a point where the majority of the supply, the majority of coins that investors are holding on to, they're in a loss. The price is below their cost basis. And why is that important? The combination of hitting the 200-week moving average and hitting a price where more than half of the supply is in loss, this has worked as a signal in the past 3 times out of 4. So in 2015, 2018, and 2020, the bottom of the market in those years occurred and coincided with these two indicators in combination. So that's one sort of little data point that you can add to your narrative to say, aha, maybe the bottom is in. This just happened. It worked in 2015, 2018, and 2020. So far, so good. Now, honest caveat, this is not a perfect indicator. Indicators never are perfect. There was a time in 2022 where we tagged the 200-week moving average, and then we broke below. And unfortunately, that was a pretty brutal bear market in 2022. We proceeded to spend 16 months below that 200-week moving average. So there's never a sure thing in markets, and this is no different. But pretty good collection of data points here that tell us maybe the bottom is in. Now, here's a couple of other data points. I'm not a big believer in technical indicators and oscillators and all the rest. When I was doing a lot of day trading, I was a price action trader. So I'm one of those people that believes everything, all the information I need to know is contained in the price on the screen. But a lot of people look at the relative strength index. So this is a technical indicator on the charts. I'm not going to get into it too much, but this is what they call an oscillator. And when the level is very high, it indicates that the asset, the pricing is overbought. It's too high. It needs to pull back. Likewise, when the indicator goes very low, anything below 30 is considered, in quotes, oversold. Well, this last Friday, we hit the deepest, lowest point in the entire cycle so far of the relative strength index. The RSI hit a level of 16. So deeply, deeply oversold. Again, if you're a believer in the RSI as an indicator, markets can always sell harder than you can possibly imagine. But this is just another data point to back up this conclusion that I take away from this, is that I believe pretty strongly that the bottom is in, or perhaps we get one more slightly lower low. Maybe Bitcoin goes down to 58, 57, 56K, maybe even as low as 55K. Maybe Ethereum dips down to somewhere in the high to mid 1400s. But I really don't think it's going to go much lower because of these different factors. The other thing that we had recently is actually what's known as technical divergence. So back in February, excuse me, 1 second, let me switch over to my other screen. Back in February, if you're looking at the coin market cap fear and greed index, you can see here at the February 5th low, we reached a fear and greed index of 5. I think it was the lowest reading ever since this index was created. Very, very extreme fear in the market at that point. And you can see here on the June 5th low, just on Friday, it definitely reached a extreme fear level, but it only went down to 13. And so this is what you call bullish divergence. The price was actually making a lower low. On February 5th, the Bitcoin low was 60,000 even. On June 5th, the Bitcoin low was 59,000 and change. So the price made a lower low. The fear and greed index made a higher low. That's called divergence. It's not the end all be all of technical indicators. It's just another data point to add to the overall narrative. And to me, all of these data points pulled together spell one conclusion. And again, I believe that the bottom is in. And again, the great thing about what we do here at Overseas DeFi and in DeFi in general, we don't have to be right. We can buy the dip. And if it dips further, well, DCA and buy some more, but get paid in between there. So buy your assets, collateralize them, borrow cheap capital against it, and deploy that capital into a liquidity position, earn some juicy cash flow while you're waiting for everything to play out. Will we go lower? Is this the bottom? I don't know, but at least I'm getting paid to find out. I'm getting paid to wait. And so we'll get into the details of that strategy here in a little bit. Let me go back to the slide deck here. And let's talk about reason number 2. Now, I like to listen to certain commentators and analysts, and it's always a good idea to listen to people that are better informed. I won't say smarter. I'm not trying to judge myself or these other folks, but people that are in this industry and they're getting paid to analyze and research crypto assets. And they just have their different channels of data and information. So I like to listen to what these folks are saying. And we have a few people here that I respect a lot in the industry. So first of all, we had some analysts coming from Bernstein. I actually haven't heard of that, but I have heard of Van Eck and I have heard of Matthew Siegel. I've watched him on many different podcasts. And so this analyst came out with a tweet basically and said, look, the 4-year cycle, it's not a thing anymore. What we're dealing with now in Bitcoin is an elongated bullish cycle. So he's saying that we're still in the bull market, that this isn't a bear market, that this is just a deep correction on our way to higher highs in the future. And why? Why does he say that? Why does he not believe that this is a bear market, that this is just a correction, that this is going to turn around, it's going to reverse, and it's going to go higher and eventually make new all-time highs on Bitcoin? The main reason for that is right here: sticky institutional buying. This is something that we've never had before in the Bitcoin market. Back in 2021, back in 2017, back in 2013, those bull markets didn't have the sticky institutional buying. Nowadays, we have all these ETFs. We have the digital asset treasury companies. We have institutions. We have sovereign wealth funds. We even have entire country governments that are buying Bitcoin. So there's a lot more buying pressure coming from this institutional capital. And it's actually, there's no retail participation. The retail traders and investors are off trading, chasing AI stocks. And recently there was a big rotation where Bitcoin was crashing. And for 4 weeks, it was just crash, 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 crash. And the stock market, the NASDAQ, was continuously making new all-time highs every single day for like 9 days straight or something like that. And I just looked at that and I said, I bet you I know what's happening. Retail investors are ditching their crypto, their Bitcoin and their ETH at the worst possible moment. And then they're taking that money and rotating it into the stock market at the worst possible moment. That means literally the definition of FOMO. They're FOMOing into the very tail end of that rally. And then sure enough, the next day, literally, I see on Friday, the NASDAQ dropped 4.2% in a single day. So I don't want to be that guy. I'm on the other side, and I'm trying to be on the smart money side of this. I guarantee you, as that NASDAQ was printing new all-time highs every single day, what do you think the smart money was doing at that? But you think they were buying? Hell no. The smart money was selling into that strength. That's what you do when you're the smart money. You sell when traders are greedy and you buy when traders are fearful. What we have on crypto, Bitcoin and ETH, we have extreme fear. Where do you think the smart money is buying? They're starting to scoop up these cheap assets. We have extreme exuberance and euphoric rally in the NASDAQ. The smart money is taking their profits. They were in a long time ago. So I want to be on the side of the smart money, which again informs what I'm doing right now and my argument for the bottom being in. But it helps to have these commentators and analysts coming down in the same, same sort of opinion on where we are in the market. And one thing that we're learning about the ETFs, I'm talking about the spot Bitcoin ETFs, the spot ETH ETFs. These are fairly new. They've only been out for a couple of years now. What we're learning is that the ETF investors, they're pretty well diamond-handed, meaning they buy that ETF and they, for the most part, they don't sell. So it's a different phenomenon than what we experience in the spot markets. And I think that has to do with the probably the typical investor who's doesn't want to bother with learning how to buy Bitcoin on a centralized exchange and then take custody themselves. They don't want to bother with all that. They already have their Charles Schwab account or E-Trade account. They just want to buy the ETF. They want exposure, but they're not going to go through the trouble of buying spot Bitcoin. They're just going to buy it through the ETF. These are well-heeled investors. These are folks that have a long time horizon. I'll bet you a lot of people are investing in these ETFs within their tax advantaged accounts, in their Roth IRAs and things like that, where they have a 20-year time horizon. They can just buy these and just hang on. What we're finding is that even though there was a massive, almost 30% drop just recently, and this is the third drop, we had a huge drop in November. We had a huge drop in early February, and then we just had the huge drop last week, culminating last week on Friday, 30% down, but the ETF outflows was only about 5% of the assets under management. So you would think with that big of a drop, it would cause more panic. That's what I'm saying. These ETF holders, turns out they're pretty resilient. They're pretty strong. They're pretty good at hanging on for dear life, right? The crypto mantra, HODL. And so all of that taken together and the targets that this analyst put out there on X, and I tend to agree with these targets. He is saying $150,000 Bitcoin by the end of this year and 200K by the end of next year. Matthew Siegel is at Van Eck. He's the head of digital asset research, so knows what he's talking about. Has been in this market and in this space for a long time. He immediately corroborated that note, that post, forwarded it, retweeted it, I guess you would say. So he's in agreement with that. And so these people, I respect their opinion. And that's another thing to add to my narrative. Raoul Pal is basically saying the same thing. He's saying, look, we're not in a 4-year cycle anymore. We have this elongated cycle. He talks about debt maturity and U.S. government debt maturity, and it's been pushed out. It used to be a 4-year cycle. Now it's closer to about 5.5, 6 years. And every 5.5 to 6 years now, the U.S. Treasury has to refinance a bunch of debt. You might have done this in your own personal financial setup, where you have maybe you have a 0% interest credit card, but then after the 12 months, now the interest rate goes up. So you go out and get yourself another 0% interest credit card, and you roll the debt. That's what the Treasury does. They don't pay off the debt. They just borrow new debt to pay off the old debt, and by the way, make all the interest payments. So there's this massive wall of liquidity that's coming, where the U.S. Treasury is going to have to refinance the debt, something to the tune of $8 to $10 trillion that needs to be refinanced before the end of the year. And that's going to produce the liquidity, and that's what stretched out the bull cycle now on not only Bitcoin, but on the business cycle as well. Everything is elongated out, and he's basically agreeing with this idea, even though Bitcoin is down more than 50% now, and the altcoins are all down 80% plus or minus. And he's still pounding the table that buy now, forget about it. He often says, buy these assets, these quality layer 1 blockchain assets, that the machine economy I was talking about, the whole financial system migrating to blockchain rails, very much in tune with that narrative and that thesis. Buy these assets, go to the beach for 10 years, and 10 years later, you'll be able to afford a private jet and fly back to your home. So I don't know about all that, but I do agree with the sentiment. You want to buy these assets and then hang on for the long term. Again, the difference that we have is we're actually able to generate some handsome cash flows with these assets. James Check, I already talked about this. He's the one that does the on-chain analysis for the Bitcoin blockchain. And that's where this came from, where historically, when the price tags that 200-week moving average and 50% or more of the circulating supply is underwater on their investment, that typically signifies that the bottom is in. That's a bottoming pattern. Now, again, I could be wrong. It could go lower. I'm not here to say that it can't go lower. It certainly could play out. But what we do is we hedge our positions. I'm going to show you that as well. I still have, even though I believe that the bottom is in, and I actually have a small long position on the futures, on the perpetuals, and I can show you that as well. Even though I believe the bottom is in, I still have a significant hedge position in place. And I can show you on our app exactly how low the price could go before I even have to start worrying about liquidation. So keep that in mind. That is the caveat. The honest caveat is that we certainly could go longer. There's no crystal ball here. There's no definity. There's no certainty here in markets. The last reason is just the extreme disconnect that we're seeing in the crypto market right now. The fundamentals behind these assets, it's never been stronger. There has never been a time as bullish as right now in terms of Bitcoin and Ethereum and certain other high quality layer one blockchains. I'm talking about smart contract enabled blockchains like Ethereum and Sui and Solana, just to name a few of the top chains. So we have this disconnect, and the price is extremely oversold. We saw the RSI. This market has been absolutely beaten down. The sentiment is totally in the gutter. And usually when an asset has a strong fundamental base to it, a strong foundation, but the market, for whatever reason, has just hated on that asset, when basically everybody in the world hates this particular asset class, those can be some of the most the best times to buy, when everybody hates that asset, but it's not going to zero. And I'm here to tell you, Bitcoin is not going to zero. Ether is not going to zero. This blockchain, this specifically is about Ethereum, the entire Ethereum ecosystem. So there's layer 2 blockchains as well, which increases the scalability and everything else. This blockchain and this ecosystem is crushing it in terms of the fundamentals. What am I talking about? So one thing is the stablecoin supply. We keep printing new all-time highs in terms of the amount of stablecoins on this blockchain. $158 billion in stablecoins. Why are so many stablecoins coming onto this blockchain? It's not for fun. This is the infrastructure. This is the plumbing of the financial system that's coming. We're not moving away from the dollar. It's just that everything, all dollars are going to be tokenized and on chain. All dollars in the future. And so that's that narrative starting to play out, and this keeps growing. This is a record high for the amount of stablecoins that is on the Ethereum blockchain or within the Ethereum ecosystem. I'm not sure if this is just Ethereum mainnet or if this also includes Base and Arbitrum and the other layer 2s. I'm not too sure about that, but I know that Ethereum is winning the game in terms of the real fundamental factors, the things that you look at to say, how's this blockchain doing? Like, okay, Brandon, I know you're telling me that everything's going to be on the blockchain, but is it really happening? Is this already starting to play out? The answer is a resounding yes. You see it in the stable coins. You see it in decentralized finance. 68% of all of DeFi is on Ethereum rails. Okay, so it's already massively winning the game. It's dominating DeFi in the Ethereum ecosystem, the EVM ecosystem. Ethereum is a proof of stake blockchain. Give me a second. That means in order to secure the network and to participate in the consensus and to process transactions and earn a yield within the Ethereum ecosystem, you have to stake your coins. You have to stake, I think each network validator has to stake at least 32 coins in their in their computer, in their validator, to validate transactions and participate in the consensus. At this point in Ethereum, we have over 1 million validators, and each and every single one of those million of validators has at least 32 coins staked in their node. What that means is that the circulating supply has diminished. Those coins are locked up and they're staying there. They're not on the market. They're not going to be sold tomorrow. No, they're locked in to the validator. They're staked, and that's how that validator is earning yield from processing and validating transactions and participating in the consensus. Now, so that's locked up supply. That's the supply that's shrinking. And what you see nowadays is the centralized exchanges. I'm talking about Coinbase. I'm talking about Binance, Kraken, Crypto.com, etc. The centralized exchanges have ETH. They have coins in their coffers, but that supply of coins, the coins that are literally available to purchase on centralized exchanges, is at the lowest point that we've seen in 10 years. Think about that for a second. The supply is shrinking and shrinking and shrinking, irrespective of the burn mechanism, which hasn't been active for a while on Ethereum. That also shrinks the supply. But we're going to enter a period of supply shock. There's just not enough coins to go around anymore, and that's going to drive the price higher. And then another way that Ethereum is winning the game here is with the tokenization of real world assets. I don't need to tell you guys this. You all have heard about BlackRock and JP Morgan, Franklin Templeton, and everybody's talking about tokenization these days. Ethereum massively dominating this in this area. So those are just some data points and some factors and some signals that, to me, signal we're in great shape here. Even though the price is way beaten down, the fundamentals are there. And what you want to do, this is an old term from the Dow Jones Industrial Stock Index. So that's made up of 30 stocks. And one of the strategies for investors, I'm not sure if people are still doing it these days, but it certainly was popular, where you would track these 30 stocks and you would invest in the handful of stocks that are performing the worst, the so-called dogs of the Dow. And the idea was that the pricing on these stocks was beaten down a little bit, but they're going to catch up with the rest of the Dow 30 stocks. Same concept here. These prices on Bitcoin and ETH massively, massively beaten down. I mean, this has been a brutal bear market, correction, whatever you want to call it. It's been brutal. We've dropped from 126,000 all the way down to 59,000, more than 50% down. So it's beaten down, but the fundamentals have never been clearer. They've never been more bullish. And it's like Ethereum is just ignoring the price when you look at how much it's kicking butt and taking names here in everything that it's been designed to do. So I've rattled on enough about that. Let me close that down. And let's talk about strategy. So I'm not here to provide financial advice or investment advice, of course, but for my own portfolio, I'm very interested in these prices. I'm happy to buy Bitcoin in the low 60,000s. I'm very happy to buy Ethereum around $1,600. But where I differ from the vast majority of crypto investors is what I do after I buy the coins. Okay, so the first step of doing what we do in DeFi and what we teach at Overseas DeFi, the first step is to do what crypto was designed to do. Crypto was designed for self-custody. It was designed so that you can be the bank, so that you don't have to trust an intermediary. You get to control the assets. They belong to you and no one can change that. So you have full control. And the way to do that in crypto is with a wallet. A wallet is just an app. For example, in EVM, anything that I'm doing on Ethereum or Base or Arbitrum, any EVM blockchain, I like to use the Rabby app. And the Rabby app is it's just an app. Okay, but it allows me to take custody of those coins. So if I bought coins on Coinbase, which by the way, I definitely wouldn't. Let me refer you to our YouTube channel. There is a strategy that we laid out in the first video of our recent series, which is this one right here. So this is a series of videos. We just released the third video the other day. It gives you the full steps and how to create a liquidity position. But in this video right here, this shows you a way to buy crypto that you may have never thought about. And this is why I would never buy crypto on Coinbase. I would simply convert my dollars to USDC on Coinbase, but then I would use a decentralized exchange to buy my Bitcoin, to buy my ETH, and I'm going to save 99% on the trading fees compared to Coinbase. So check that video out if you haven't seen it. Once I buy the coins, I'm going to take possession of those coins, my USDC, and I'm going to go to a decentralized exchange. Again, I explained this in this video. I'm going to buy my ETH. I'm going to buy my Bitcoin. If you're like me, you're way more bullish on Ethereum than on Bitcoin. I am bullish on Bitcoin. Don't get me wrong. I'm just way more bullish on Ethereum and SWI. So my allocation looks like about 80% ETH and 20% Bitcoin. If you just look at Bitcoin and ETH, if you look at SWI, I don't know what the numbers are. My point is I'm heavy on the ETH because I believe in that narrative. I believe in the unlimited upside potential of the machine economy and the 80-to-1 agents versus humans and all these new economic actors doing transactions, processing transactions on the blockchain. So I'm heavier on ETH. Once you have your assets, now it's time to collateralize those assets. And this is the real unlock. Okay, so let's run through an example, and we're going to use the Overseas DeFi app. By the way, if you sign up for our Overseas DeFi community, it's $97 a month. You're going to get this portfolio tracker app. A lot of nice tools built into this app. I'm going to show you one of them right now. We also have a fully trained DeFi Overseas DeFi agent, fully trained on all of our strategies, all of our workshops, all of our open office hours calls, all of our frameworks, basically everything and anything that we've ever done within the halls of Overseas DeFi. This AI agent is privy to all of it, completely trained on all of that. So it's not just another chat GPT where the answers that you get to your questions like don't even make sense and they lead you down the wrong path. No, this AI is going to be able to really help you out as you're going through your journey. So sign up for that. Like I said, $97 a month. It's really cheap compared to some of the fees you can generate, and we're going to get into that. Now let's use this is the Lend Borrow tab. So once you have this app, you're able to connect your up to 3 wallets now. My business partner recently expanded and upgraded the app to be multi-wallet now. And you can take a look at your lending and borrowing positions, and you can kind of simulate what this would look like. So let's do that now. I'm going to do an example as if you had, let's say you had $10,000 to deploy. Now, DeFi is open to everybody, and the returns and the yields that you can earn, it doesn't matter if you're playing with $100 or $100,000. The opportunity it's equal. Everybody is able to earn the same types of yields and returns on their assets. It's just relative to how much money you put into it. So don't worry about it if you don't have 10,000. If you have $100, you can still start today. As long as you have an internet connection, You can get started with this. You can learn it. By the way, you don't have to pay us. You can learn how to do it on YouTube. That's why we did this recent series of these first 3 videos, and I will have a 4th video coming up relatively soon on that. You could just watch those 3 videos and learn how to do it on your own. I take you step by step through in those videos, but it is really nice to have this tool. Excuse me, that's not the screen. To have this portfolio tracker built into our app. You also have all of your different video lessons, the workshops, the strategy sessions that we do on Thursdays, all of the video course modules. What else? The open office hours. Maybe I said that already. Anyway, tons of video content for you to watch in this platform. We have a market intel tab, so you can see everything that's happening in the broad market, the PMIs, the CPIs, all the acronyms, the non-farm payrolls, all that data comes into the market intel tab as well. And then in the portfolio, if you go into the lend borrow section, then you're able to simulate your position. So let me clear some of this out. I'm going to say, let's just scale this down. Let's see, how much would that be? That would only be about $600. Let's say that is so about $2,000 in Bitcoin. I'll go ahead and get rid of this. And then let's say our ETH. And by the way, I should clear this out. So let me get rid of this debt. Let's bump this way down. Let's make this $5,000. And then, so let's say you spend your $10,000 and you buy yourself about $2,000 of Coinbase wrapped Bitcoin. And let's see if I can guess. Let's see what that would. No, you'd need a little bit more than that. Let's see what 5 looks like. Okay, close enough. So your total portfolio here would be about $10,000. Okay, so you have $10,000. It's working for you. Why is it working for you? Because it's invested in assets that you believe in, and that long term, the price is going to go up. I can't say that with certainty, but I'm very highly convicted that these assets are going to go up over time. The government, the central banks, they are not going to stop debasing the fiat currencies. So these numbers will go up. So that's working for you. If the prices go up, you're making money on that part of your investment. Now, when you collateralize that, we like to use Aave. It's the longest running lending and borrowing. Oh, my dog's trying to die. 1 second. Shh, stop. Okay, stop. He always picks the worst possible times to have a little coughing attack. All right, so we have our assets. We bought those on a decentralized exchange, so we could save 99% on the trade fees. Stop. He won't listen. And we put those coins into Aave. Now, there's a trust element there. You have to trust the code. It's in a smart contract, so you're sending your coins to the smart contract. I'm not going to tell you that things can't go wrong, but I will tell you that Aave has been around the longest. It's the most audited, most battle-tested, longest-running DeFi lending protocol out there. So I do feel very, very safe with Aave and putting my coins as collateral on Aave, but it is not risk-free. So now I have my collateral that allows me to do collateralized borrowing. So Aave will allow me to borrow money against that collateral. Now, just to give you a sense of what's the interest rate that I have to pay on this loan, 4% currently. Now, this is an adjustable rate. It goes up and down with supply and demand, but I've been doing this for almost 5 years now, and I can't recall ever seeing a rate in the 2 digits. Typically, I'm used to seeing somewhere around 5%. Sometimes it's a bit lower, like now. Sometimes it might climb to 6 or 7%. in rare occasions, but it's a very low interest rate compared to what we do with our DeFi carry trade, where we borrow this capital at this low interest rate, somewhere around 5%. But when we deploy that borrowed capital into a liquidity position, we're able to earn much, much higher yield than 4%, at least 10 times that, if not 20 or 30 times that. So I'll show you that as well. So that's the next step, is once we have that collateral posted, now we're able to borrow. Now I mentioned, what if I'm wrong? What if this isn't the bottom? And what if it keeps going lower? Well, then the question is, how low could it go? I can't tell you. I cannot tell you how low it will go. I think it's already gone as low as it's going to go, and it's going to go up and to the right from here. But I just can't say that with certainty. So one of the things you can do in this app is you can play out different scenarios with the price. So notice when I'm clicking this button, the price is dropping. And you can see the price of ETH over here. It's going to take your largest asset over here and put that price on the slider. And as the price drops, the price here is dropping, the loan to value ratio is climbing. You see that little red line right there? That is the liquidation threshold. So when you're doing this kind of lending and borrowing, first of all, you don't have to pay back the loan. Like literally, you could borrow the capital and never pay it back, as long as you don't get liquidated. So if your collateral, let's say it stays at the same value, or maybe it appreciates 5 to 10% a year, year after year, as long as you're not hitting this liquidation threshold, you literally never need to make a payment on this loan. You never have to pay the interest. You never have to make a principal payment, nothing, as long as you don't get liquidated. Now, if the price does drop and your collateral goes too low, you'll hit the liquidation threshold. The protocol will pay that loan off for you. In other words, it's going to take your collateral, most of your collateral, it's going to sell it on the open market, and it's going to repay the loan on your behalf. And that happens automatically. There's also a penalty fee when that happens. Trust me, you don't want yourself to get into that situation. So obviously avoid liquidation. But this simulator allows you to see kind of your drop dead price. So as I keep going down with the price, we're down 40% now from current levels, and we're just right there at liquidation. Probably if I click it one more time, yeah, there we go. So it looks like this lending and borrowing position would be able to survive even if the price of ETH drops down to $1,000. Now, is that possible? Of course, it's possible. Is it likely? I really don't think so. I don't think it's likely at all. But this is the game that you play when you do this kind of borrowing against your collateral. You do have to keep in mind your drop dead price or your liquidation price. And this app is very useful for doing that. And as I showed you earlier, my liquidation prices here on ETH is in the neighborhood of $1,200, about 46,000 on my Coinbase wrapped Bitcoin. Okay. So that's very important when you're doing this kind of borrowing. You want to be conservative with it. And notice if I reset this, basically I'm borrowing, if it'll cooperate, there we go. I'm basically borrowing about 50%, right? I put $10,000, a little bit more than $10,000 in my collateral, and I borrowed half. So this money, it comes directly to your wallet. There's no credit form, there's no credit check. There's no forms to fill out. There's no waiting. This is instant. You have the collateral, you get the loan, guaranteed instantly. And that money comes out to your wallet. You can do whatever you want to do with it as long as you don't get yourself liquidated. You can never pay that loan back. Take it and do whatever you want. What we like to do one of the things I like to do is use that borrowed capital to buy other assets when they go on sale. For example, I reallocated some borrowed capital over to the Sui blockchain and increased my Sui position recently on the big dip that we've had. But for the most part, what we like to do with this borrowed capital is provide liquidity on a decentralized exchange. Now, I won't get into the details of that because I literally just posted a video yesterday that explains the full process, okay, step by step into how you can provide liquidity on a decentralized exchange and earn these kinds of yields that we're talking about. I will just give you a couple of examples. My position in Rabby paired with USDC, that doesn't seem to want to update. So let me look at the turbos position. So I'm actually running 2 liquidity positions at the moment. I would say one of them is a little bit more risky than the other, but it's also much higher on the yield. So here's my position on turbos. This is a decentralized exchange on the Sui blockchain. And currently at this moment, the APR is over 300%. So think about that for a second. You borrow some money, you're paying 4%. You take that same money, put it on the Sui blockchain, plug it into this liquidity position, all of a sudden you're earning 300% on that money. Now this is going to fluctuate. It depends on swap volume. It'll slow down on the weekends. Your yield will go down. It'll go up. It'll fluctuate. I can tell you, I've been running this position for several days, and my average yield on this, based on the real data, every time I collected fees to my wallet over the course of the last week or so, it's running a little bit over 300% right now on average. The first day was crazy. I made more than 1% in a single day. That's 365% APR. And then it kind of ebbed off a little bit, but on average, it's about 300% on this position. This one here, the fees are a little bit lower. We're still talking about 80, 90, maybe 100% APR. Again, this is going to fluctuate, but these APRs are crazy compared to where you can borrow that capital and what you're paying on that interest rate for the borrowed capital. So there's kind of 2 main things to our strategy and our portfolio structure. The one key feature of our structure is we take those assets, we take possession, we custody the assets ourselves, where we control it in our own personal account on the blockchain, and we collateralize those assets because we want to borrow that cheap capital. That nobody does that. I'm telling you, almost everybody buys their coins and just lets them sit there, maybe for years, in the Coinbase exchange or in the Kraken exchange. They never take possession. They never even take that first step. Maybe they do. Maybe a few percent of crypto investors actually take possession of the coins, but they aren't lending and borrowing. Okay. So they're not unlocking that extra chunk of capital. That's called velocity. I have $10,000 working for me because it's invested in assets where the price is going to go up. But then I borrowed an additional $5,000, and I'm putting that borrowed capital to work for me too, generating a very tasty cash flow. So now I have 10,000 plus 5,000. I've got $15,000 that's working for me. And this is something that you don't have to look at this for hours on end. You can check it once a day. Depending on how wide your range is, you might check it once a week, collect your fees, and move on. So this is nothing like day trading where I used to do that for more than 10 years. I was day trading, spending hours and hours looking at the chart. every single weekday. It was a tremendous drain on my time and energy. I don't want to talk about it more. This is nothing like that, though. This is a very low time commitment to manage these positions. Often there is nothing to do other than to collect your fees. I already collected my fees today. I got another $2.80 waiting there for me, about $9,400 in that position. And most of the time, that's it. The price is still in your range, nothing to do but collect your fees and move on with the rest of your life. Okay. So that's the other key feature. It's the lending and borrowing where we unlock that extra capital and we put it to work. And then the specific way that we put that capital to work is in these decentralized exchanges. We put that capital into a liquidity position. Look, it's not rocket science, but it's not point and click either. There is a learning curve into becoming a liquidity provider and earning these kinds of yields. It's not extremely difficult, but yeah, it's not one step and you're done. Okay, you don't download a single app on your phone and that's it. You have to go through the steps. And again, I did explain the full process here. I mean, as quickly as I could, or as best I could on a 15-minute video. Obviously, I can't go really deeply into the details, but you're going to be able to figure out the steps. And listen, join the community, try it out, $97 a month, cancel anytime, no commitment, and learn what you need to learn and start doing this. Always start small as you're learning the ropes, you're getting your reps in, you're clicking on the different buttons, you're doing the transactions, you're coming back, you're collecting your fees, and on and on. As you're going through that, start small. Start with $100, start with $500, something where if you make a big mistake and the money goes bye-bye, you're going to be okay. But start out small and get started today. There's no reason why you can't try this out. If you have an internet connection, it's very easy to do. We tried to make it as easy as possible with these videos here. And also every Thursday, 6 p.m. Eastern, I go live right here on YouTube. So make sure to subscribe to the channel and most importantly, turn on those notifications. That way, if you do get stuck, you can tune in for this live stream, and I would love to help you if you have a question about setting up your wallet, setting up your position, doing your range, lending and borrowing, any of these DeFi things. If you get stuck, you have a question, tune in for the live stream. I would be happy to help. So I think that's going to be it for the stream. I really appreciate those of you who are able to tune in live. If you're watching the recorded version, thanks for watching the video. Make sure to like the video, leave a comment down below, subscribe, and again, turn on those notifications. That way you can catch the live stream next week. Maybe you have a question. I'd be happy to help. All right, that's going to be it for the stream. Thank you so much for watching. Have a good night, everybody.